When someone starts earning and becomes financially independent, he starts to spend and save as well. The spending and saving behavior, however, differs from person to person. While some overspend with financial independence, some become more responsible and they start to save and invest. As a newbie to the world of investing, you'll have a lot of questions, not the least of which is how do I get started and what are the best investment strategies for beginners? Well, if you're someone who is all set to invest your hard-earned money, but you're confused as to where you need to invest your money in and how much of money you need to invest and how to begin, then this video is definitely for you. So do make sure that you watch this video till the end and you are all ready to start your journey of investing. So in today's video, we shall discuss all the things that you need to consider and what you need to know before you start investing. Hi, I'm Namita. Welcome to IndianMoney.com. Let's get started. So the very first key thing that you need to keep in mind is you need to define your goals. Well, many people commit to equity SIPs, ULIPs or 15 to 20 year insurance products early in their career thinking this will help them build wealth. However, you need to remember that a long-term products can actually deprive you of quick cash when in case of emergencies or to fulfill your short-term goals. Now, mapping out your financial goals with their timelines before you choose the product will definitely help you to avoid any kind of money shortage. So start your investment plans by putting some thought into why you're actually investing in the very first place. So you need to list out some financial goals you would like to achieve within say in a year or say in 1 to 3 years time or 3 to 5 years time or by 7 years or beyond. The goals need not be like buying a 3 BHK or acquiring some bitcoins. Even modest short-term goals like taking a vacation, replacing your smartphone or giving your parents or your partner a surprise gift can definitely count. Now in case if you have a debt to pay of let's say an education loan, then get to that first by adding it to your less than 5-year goals. Now once you have a list of goals that you have mapped out by their time horizons, and then asset and product choices are very simpler. For goals that fall, say, within 3 years period of time, safe avenues such as recurring deposits, post office deposits or SIPs in short-term debt funds are a good option. Now, for goals that have, say, 5 to 7 years of horizon, SIPs in hybrid mutual funds, deposits with NBFCs, post office schemes like NSC or anything is a very good option. Also, for long-run goals like retirement, SIPs in equity funds, stocks and NPS are a very good bet. Stock market or equity funds should figure in your portfolio only if you're willing to give the investment a minimum of 7 years horizon to deliver. The next key thing you need to remember is you need to start investing early. Well, starting to invest at a very young age will let you utilize the advantage of long-term investment horizon to the fullest. As you have the age on your side, you can go with the aggressive approach in your investment strategies. Even if something goes wrong, let's say, then you still have enough time on your side to recover and make good profits thereafter. Hence, starting to invest early is a key to making the most of the investment opportunities. The benefit of compounding and accumulate considerable wealth is maximized when you start investing process at a very early age, even with the small savings. Now, even if you start early and with the help of compounding, you will end up accumulating wealth even without huge investment amount or savings. To start with, you can put away and invest even 5 to 10% of your salary can go a long way. Now let's take for an instance, if you earn a salary of say rupees 30,000 per month, then you can plan to invest about 10% of your salary, that will be investing about 3,000 per month. Now if you start investing in your late 20s through say SIP in mutual funds for the period of 35 years, you would have invested a sum of rupees 12.6 lakhs approximately and your money would have grown to rupees 1.9 crore. Now this is when it is an expected annual return of 12%. Comparatively, if you had invested say the same amount, like the amount in your late 30s, then it would have fetched you about 56.9 lakhs approximately by investing rupees 9 lakh in 25 years. Moving on, the next key thing you need to remember is you need to decide how much of money you're willing to invest. Well, how much of money you need to invest depends on your investment goal and by what time you need to reach that goal. The next key thing you need to remember is your risk tolerance. How much of financial risk are you willing to take? That is the next thing you need to ponder upon. So, not all investments are successful. Each type of investment has its own level of risk, but this risk is often correlated with the returns. It's very important to find out a balance between maximizing the returns on your money and finding a risk level you are comfortable to take. Now let's say, take for an example, bonds will offer you a predictable return with very low risk, but they also yield relatively low returns, about 2 to 3% only. Well, in contrast, stock returns can vary widely depending on the company and the time frame, but the whole stock market on an average will give you the return of 10% per year. Even within the broad categories of stocks and bonds, there are a huge difference in risk. Now, I'll give you another example. Let's take for an example, a treasury bonds or AAA rated corporate bond is a very low risk investment, but these will likely have a relatively low interest as well. Savings account represent even a lower risk, but will offer you again the lower returns. While on the other hand, a high yield bond can produce greater income, but will come with greater risk of default as well. So when you're actually deciding to invest, you need to actually take into consideration what are the risks you are willing to take? How much of amount of risk are you willing to take? So depending on the risk you are ready to take, your returns also varies, or it depends on that. Now moving on, the next one is diversify. Now, as different markets rise and fall, a diversified portfolio of different types of investment funds can definitely help you to stabilize your portfolio over an economic cycles. Now, investing exclusively in one particular markets, sectors or companies can leave you exposed to unforeseen issues occurring in one particular area. Investing across the range of asset classes, regions and sectors will help you to mitigate any potential losses and will help you to maximize the long-term returns. Moving on, the next one is simple products. Now, there is a misconception that many beginners have that the complex products will get them faster to their goals. While on the contrary, investing in something that you don't understand will make it even difficult to stay in course. Now, when you select products, make sure that you understand where your money is going and how much of return that you will be delivered with. Now, in insurance plans, it is enough to start with a pure term cover and a basic Mediclaim policy. For your emergency fund, a fixed deposit with a leading bank will suffice. Moving on, the next one is you need to avoid any kind of debt trap. Well, most people are now seeing using anything and everything on EMIs without actually waiting to accumulate money to purchase the expensive things. Note that not maintaining these EMIs properly can lead you towards a debt trap. Most people give in to the temptation of borrowing money and not notice the high interest that comes along. This also includes the excessive usage of credit cards, even for small basic consumptions. Now, you need to keep in mind that while you use credit, you need to regularly pay your credit card bills and loans. Also see to it that your total credit, including EMIs, credit card, etc., should not go beyond 40% of your total income. The last one, and which is the most important thing that you need to keep a note of, is you need to prepare for emergencies. Well, our best made plans can go haywire when acts of God or emergencies strike. During COVID-19, many people actually saw their savings depleted because multiple family members had to be hospitalized. Some family members also lost their breadwinners as well. Well, those who actually escaped these serious adversities saw their employers hand out pink slips or cut their pay. Unforeseen emergencies of this kind can actually force you to dip into savings and stop regular investments or even withdraw money from your retirement funds. So the solution is insurance plans. Now, insurance plans are the most cost-effective way that can shield you against such risk because the insurer pays you and your dependents a big lump sum against a nominal annual premium. The other one is pure lifetime plans, which compensates your dependents for the loss of your income on your untimely passing. The next one is health insurance, which the health insurance plans actually cover medical expenses in the event of hospitalization. Critical illness covers pays you a lump sum if you're diagnosed with serious illness that interrupts your career or income. While the other one, which is household insurance, it protects your home and your other assets against natural calamities. So these are the 4 types of insurance that you should seriously think of getting at the very early stage of your career. Insurance plans, however, tend to have many exclusions that might leave you unprotected in some unforeseen emergencies. To be able to tide over such events, it helps you to have an emergency fund parked in liquid and absolutely safe avenues. So these were some of the key points that you need to take into consideration, especially when you're beginning to invest. Investing money can sometimes feel very intimidating, especially when you have never done it before. However, if you have figured out these key points, then the money or the returns you'll get will definitely serve you well for the decades to come. Also, if you're someone who wants to learn more about investing in mutual funds, investing in stocks, PPF, EPF, or any other schemes or instrument venues, then you can hurry up and download the Financial Freedom app, wherein we teach you in detail how you can invest in these funds. Also, before going, do not forget to hit on the like button, subscribe to the channel, and hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.